The COVID-19 pandemic has throttled economic activity and dragged down corporate profits. And as the disease has spread, a cascade of bankruptcies has followed, with no end in sight.
It's a natural consequence. Small and big businesses struggling when, they haven't got clients coming in.
The prognosis is grim for many companies and entire industries, not to mention for investors caught in an outbreak of distress.
I do think people are going to have to be patient and people are going to have to be creative.
Meanwhile, governments and central banks are pulling out all the stops to slow the torrent of red ink.
That has distorted normal recessionary dynamics and, again, postponed many of the credit consequences which we're likely to see over the longer term.
What's driving all of these defaults, and how deep will the damage go? The bankruptcy breakdown is straight ahead. Welcome to a Bloomberg special report, The Bankruptcy Breakdown. I'm Lisa Abramowicz. The size of the current bankruptcy crisis is painfully evident. Each week, we get more firms joining a parade of businesses filing for protection. In this program, we'll examine the shape of the problem, how it's spreading through the larger economy, and why policymakers are finding it so challenging to contain. Let's begin with a look at how quickly bankruptcy has gone from last resort to the new normal. This has been an unprecedented year for corporate unraveling. Never before have so many retailers and healthcare companies gone bankrupt in such a short time. Every sector has gotten hit, from the beaten-down shale patch to airlines to sports leagues. Companies have put the blame for bankruptcy on the pandemic, which is partly true, but many were already fragile after taking on record amounts of debt during a decade of low interest rates. Hertz is a perfect example. The iconic rental car company filed for bankruptcy in May, with revenues all but drying up as travel ground to a halt. But it also had failed to build a big enough cash cushion relative to its $24 billion of debt. Hertz's story is not unique. This may end up being the worst year for corporate defaults in history. The 6 biggest U.S. banks set aside $35 billion in second quarter alone to cover potential loan losses. The numbers would be far worse if policymakers hadn't fired a bazooka, injecting trillions of dollars of fiscal and monetary support into the global economy. These measures have propped up markets and emboldened investors to plow into riskier securities. But all that hasn't been enough to offset the consequences of a recession. Companies are still struggling to survive with little income and ballooning debt after borrowing record amounts of cash to stay alive during the pandemic. Investment-grade companies in the U.S. sold a staggering $1.3 trillion of bonds in just the first half of the year, exceeding all of last year's issuance by more than $65 billion. Defaults, downgrades, distress. By one model, this year's spate of mega bankruptcies is just getting started. Take a listen to recent comments from Ed Altman, NYU professor and creator of the Z-score, which is used to determine corporate distress.
There are now probably about 33 billion-dollar bankruptcies so far this year. And if that continues at a similar rate for the rest of the year, you're talking about around 65 or so by year end. The previous highest of these mega bankruptcies was 2009, when it was 49. So we will easily break that record. And that's partially due to this huge increase in high yield bonds and leverage loans of companies that are very large. And we've seen some very, clear numbers about this and very well-known companies.
Credit analysts are trying to game out just how bad things could get. In its base case scenario, S&P Global expects the U.S. default rate among high-yield companies to hit 12.5% by March. That would rival peaks last seen in 2009 and 1991. In a worst-case scenario, the credit rating company sees the rate spiking above 15%, which would by far be the highest in modern history. Still, despite the precarious debt burdens, many companies are borrowing even more to survive. Ralph Schlosstein, co-CEO of Evercore and former president of BlackRock, laid it out on Bloomberg Surveillance.
In 08 and 09, we learned that financial institutions fail not because of capital, but because of liquidity. And in this recession, deep recession, we have learned also that that phenomena is more widespread. So we spent a lot of time in the last 4 months encouraging companies to put more cash on their balance sheets.
But here's the conundrum, Ralph, because we're heading into a period of slowing growth. We have a more fragile economy and we have more indebted companies. Why not just file for bankruptcy? Why not renegotiate the debt loads now with creditors to reduce the obligations rather than putting their entire capital models in a more precarious situation?
Well, there is some of that going on as well. I think the real issue in terms of how to solve one's balance sheet issues depends upon the outlook for the business. If it truly is a V type downturn and then recovery, then it's just a matter of having the cash to survive to the other side of the chasm. Other businesses obviously are going to be more seriously and permanently impaired, and for them, bankruptcy and recapitalization is the right model.
Banks are girding for things to get worse, setting aside billions of dollars to absorb losses tied to future insolvencies. Morgan Stanley's James Gorman told Bloomberg he sees little chance that banks can get ahead of the reckoning that's coming.
Well, I don't know that you can get ahead of it. I mean, it's a natural consequence. Small and big businesses struggling when, they haven't got clients coming in. I mean, look at the restaurants, look at all the small businesses, the hairdressers and the doctors and the dentists, and before you even get to big companies. So, that's part of why we saw such a massive wave of financing in the last quarter, as a lot of companies got ahead of that and built up stronger balance sheets in anticipation of these tougher times.
The cost of this crisis will be massive, both socially and economically. Many investors are already cutting their losses and selling holdings in distressed companies at steep discounts. But others are eyeing opportunity. NYU's Ed Altman weighs in.
With these huge amounts of new bankruptcies and defaults, the supply and demand for these securities has tipped much more toward a buyer's market. And that's why the distressed investors are somewhat pleased about what's going on, because they've been waiting for this deluge of new bankruptcies and defaults, and what that means in terms of not only the recovery rates to the existing investors, creditors, but also what they have to pay to purchase these companies, many of which will be restructured well in Chapter 11. And that's now signaling a boom market for the distressed debt market. And money is flowing into these funds at a fairly high rate at this point.
Coming up, a global leader in corporate restructuring says she sees more bankruptcies coming as the year continues. And she tells us which industries may feel the most pain.
I think we should be looking to see what's happening with real estate.
This is Bloomberg. Investors watched with alarm as defaults surged in the first half of 2020. In June, Marathon Asset Management CEO Bruce Richards told Bloomberg he sees even more trouble ahead.
There's a lot of problems brewing. And so what do we expect with default rates? Well, we've recorded at Marathon since the beginning of COVID, since mid-March, we've recorded 60 bankruptcies here in the United States, totaling about $100 billion. And we think that $100 billion number will grow to $400 billion. That is, the 4.5% default rate will grow to 18% cumulative, which takes you to an annual default rate of about 10. So default rates, as you know, is measured in trailing 12 months. And so we'll go from 4.5% to 10, but before this is all over, it'll be a cumulative rate, which is 4 times the 4.5% that we've already seen, 18%, taking you to $400 billion.
Welcome back to Bloomberg's special report, The Bankruptcy Breakdown. I'm Lisa Abramowicz. Bruce Richards, like many others, expects to see a surge in defaults as the year progresses, but bankruptcy is hardly a one-size-fits-all solution. Some companies will cease to exist. Others will restructure and emerge. Still, with no prospect of a quick economic recovery, it's difficult to devise a plan to stay afloat. I asked Lisa Donahue, global co-leader of turnaround and restructuring at Alex Partners, how she thinks companies will be approaching these challenges as the pressure of debt intensifies.
It's going to be an individual type situation. U.S. Chapter 11 can actually be a quite effective tool. And remember, U.S. Chapter 11 is more about actual rehabilitation and fixing a company and having it come out on the other side, whereas sometimes in other countries, it's more about a managed wind down. So what a bankruptcy can do for some of these companies, if they find that they're essentially running out of cash, which is one of your inflection points on figuring out if that's the right thing to do, is you can delever, you can more effectively shed non-core businesses, you can effectively look toward closing unprofitable operations, things like that. So it's a tool that can be used to help some of these companies deal with some of these perhaps lingering problems that they'd had. So it's not necessarily an end of the road, but it can possibly be a tool to help some of these companies out.
Given the scope of bankruptcies, given the scope of the pain, given how much debt was built up over the decade ahead of this, how low do you expect some of the recoveries to be for debt investors?
Predicting debt recoveries is not something that I don't think anybody really wants to do. But what I will say is I was reading an analysis about the typical recovery time post a recession. And it is averaging somewhere around 3 to 3.5 years to get back to equilibrium. And when I say equilibrium, I mean kind of normal operating back to pre-pandemic, pre-recession levels. So if you think about a 3-year period to get back to where you were before, whatever you were doing from a manufacturing operational perspective, I don't necessarily think that the recoveries are going to be less than prior recessions, but I do think people are going to have to be patient, and people are going to have to be creative, and people are going to have to recognize that this is something that we've never seen before, and that the strong companies will come out on the other side, and smart management teams will proactively look for ways to extend their runway and to manage through a lower productive environment to get to profitability on the other side.
How concerned are you that a number of corporations are borrowing more and more money, billions of dollars, to get to the other side when they don't know when the other side will be or what it will look like?
I'm less concerned with companies that are doing that, because in order to preserve their value and in order to get to the other side, they need liquidity. So, and the capital markets are very frothy right now. There's a lot of liquidity out there. So I would say looking at not just the amount of debt, but how their debt behaves, what kind of debt they have, how long-term it is, how prompt it is, when their maturities are, what sort of flexibility they have built into their debt. Now, obviously, too much debt is never a good thing, but I've talked with a good deal of CFOs and CEOs of healthy companies that did proactively go out and raise capital with the intent of managing their cash so that when they do get to the other side and it is clearer on what's going to happen, they can quickly pay it back down and delever. So it's not a question of issuing debt for debt's sake. It's a question of getting the flexibility that you need from a liquidity perspective to weather through whatever time period we're looking at with this pandemic.
Lisa, you talked about how we've seen a lot of bankruptcies in retail, certainly in energy. What's the next industry that you think is likely to get hit?
Wow. I don't think we're done with energy yet. I think oil and gas is going to continue to struggle for a whole host of macro factors that are not necessarily pandemic related. I think we should be looking to see what's happening with real estate. We should, and then the longer this pandemic goes on, we may see larger enterprises that might normally not have any sort of distress end up having to go in distress. Automotive is ripe for ripe for disruption, given everything that's happening in their supply chain and moving toward electric vehicles. That's something that could be accelerated, some of the changes that'll happen in that supply chain. I think aerospace and defense is an area that we're continuing to look at and see what's happening there from a distressed perspective, from a supplier perspective to some of the big majors. And obviously, I mentioned hospitality. I think that the whole hospitality segment is geared on people moving and vacationing and having the ability to rent cars, stay in hotels, take cruises, fly on planes. And as long as people aren't moving, that's a sector of that, all of that whole hospitality could be in a lot of trouble.
Coming up, policymakers have acted swiftly and aggressively to throw lending lifelines to struggling companies. But Citigroup's Matt King thinks they may just be postponing a crisis, not preventing one.
In many respects, what we think is happening is effectively zombification. Businesses are remaining alive that would normally have folded by now.
This is Bloomberg. Welcome back to a Bloomberg special report, The Bankruptcy Breakdown. I'm Lisa Abramowicz. While the economic impact of the COVID-19 pandemic has been devastating, the response from policymakers has been extraordinary. How effective it will be remains to be seen. I asked Citigroup's Matt King if he thinks unprecedented stimulus will head off a bankruptcy crisis or just postpone a destructive second wave.
The standard joke is you don't become solvent by borrowing more money. And what is it that we've done is we've massively facilitated borrowing by corporates across the board and SMEs. And in the US, even consumer incomes have gone up once you include all of the government benefits, which is really weird during a recession. And so it's very natural that that has distorted normal recessionary dynamics and, again, postponed many of the credit consequences, which we're likely to see over the longer term. At the same time, as businesses reopen but need to spend money engaging in distancing, or as they find that they've tapped the extra liquidity but they still haven't got the revenues, we do actually expect to see a steady stream of further problems, and some of those have been showing up already in downgrades from the rating agency and defaults. The weird thing, therefore, is not so much the way that the problems haven't occurred at all, it's the way in which the problems which have occurred haven't created the contagion or haven't had the broader market impact or broader effect on repricing that we would typically have expected.
Do you think that there will be some sort of contagion or effect later on as the pandemic continues?
That is feeling less and less likely. And I think an awful lot depends on how the central banks respond and whether they just act as a backstop in the way in which they sort of claim to be doing, or whether they do what I fear they're actually doing, which is inflating larger and larger bubbles. So in many respects, what we think is happening is effectively zombification. Businesses are remaining alive that would normally have folded by now. And then we can debate whether or not that's good, but at a minimum, it makes everything less abrupt than it might normally have been. At the same, and if the central banks are prepared to give this backstop liquidity, preventing markets from overreacting, preventing fire sales and outflows as they were doing in March, I think everyone would agree that that is a good thing. There was this concept in the 1930s that bankruptcies should be allowed to burn themselves out, and they didn't burn themselves out. They actually built on one another, and the whole thing was a disaster. And so in that respect, it's very, very good what's happening. At the same time, there is this, the more inflated are the market valuations, and there is this weirdness. We're getting the worst economic data we've had since the 1930s, even if we've probably seen the bottom now. There's this massive gap between that and market valuations. Equity markets, in some cases recently having made new highs almost as though nothing happened. And the more inflated are those valuations, I think the greater is the risk that at some point you do lapse to fundamentals.
When you talk about pushing out the pain, the idea that a lot of these companies that have been in dire straits have borrowed more money to stay alive, Will that have possibly worse consequences down the road? The idea that debt loads have gotten bigger at a time of slowing growth and an increasing potential amount of risk aversion down the line should central banks pull back?
Depends a little what you mean by worse. So can it be worse than what we have seen to date? Is it not the nice bounce back and fully V-shaped recovery and return to the way things used to be? Yes, absolutely. You can't carry on leveraging up indefinitely. And in principle, yes, could you imagine something worse still, whereby the central banks lose control of the markets and you're really getting a nasty sell-off? Yes, I can imagine. And the more elevated the valuations and the more debt there is in the system, the greater is the vulnerability there. Most of what I would expect, though, is a bit more benign. It's this sort of zombification or Japanification. It's a bit of a continuation of actually what we've seen the last few decades, which is there's more and more debt in the system. Whenever real interest rates edge upwards, markets suddenly sell off as people take money out and go back into risk-free assets, precisely because they were sort of forcibly being crowded into buying riskier assets. And so you become kind of more and more trapped in this environment with a large debt overhang, but where equally it doesn't quite erupt into uncontrolled bankruptcies and depression in the way in which you would have thought. It's more a steady stream of, as I say, sort of zombification or growth being more disappointing than you would have imagined, unemployment being more elevated than you might have imagined. And then we get into a debate as to whether that was a good or a bad thing.
Given where policies are right now, which regions do you expect to actually see insolvencies, to actually see policymakers allow companies to go bankrupt at a faster pace?
It's been a bit less about one region being more affected, and it's a bit more about how the effects have been moved away from the large corporates, which could be more systemic, for example, with the Fed buying fallen angels, and instead the effects are being a bit more concentrated on the small and medium-sized companies, maybe hitting bank loan portfolios, rather than the names which are big in the bond market. And by and large, I expect that to be the case. Sectorally, there are also interesting differences that we haven't fully seen play out. But I think there's a big difference between, say, somewhere like the US, where up until now you've been incentivized to pay your rent, pay your utilities, pay your employees, and then the loans can become grants. And then say somewhere like the UK, where instead it's almost been the opposite, and you've not been able to evict a tenant that wasn't paying their rent. It's almost as though people have been encouraged not to make those payments. And I think we'll begin to see some sectoral and regional differences coming through as a result.
When you talk about how the bond market maybe is going to be kept afloat perhaps more than the loan markets in certain segments, which investors or which actors do you think will absorb the bulk of the losses as there are insolvencies and as recoveries are lower?
That's a good question, because the whole effect is to disguise it and postpone it to the point where people almost forget who's taken the loss rather than having the loss and then repricing. And in fact, one historical episode that comes to mind is in Japan, when the bubble burst in 1990. You didn't really get the pickup in bankruptcies until 1997, 98, when the banks were recapitalized and almost allowed to take the losses. I'm still, though, generally inclined to think that it will be more in the banks, which are provisioning a lot as things stand, maybe likewise some of the CLO portfolios, again, the smaller companies, rather than, and also some segments of the high yield bond market. What's really happening is this strong segmentation at the moment, and the big difference in risk premium between the areas receiving direct support and those that aren't.
That wraps up our special report, The Bankruptcy Breakdown. Stay tuned to Bloomberg Television and Radio for ongoing coverage. And visit Bloomberg.com for all the latest news and analysis 24 hours a day. Stay safe, everyone. I'm Lisa Abramowicz, and this is Bloomberg.